All right, coming back out, it is 1:10 on your clock. I'm Julie Kay. We have some live feeds for you. We're going to start with Jerome Powell. That is the Federal Reserve Chair. He is speaking live for the first time since the first interest rate cut of the year. So really important stuff. Let's take a listen in.
I'm not a PhD economist. I read it 20 years ago.
But you said it still holds very much true today.
It does. And I think it's a good explanation for why the U.S. has had, rising inequality. This is their thesis, and I think they call it also skill-biased technical change. So you need skills to benefit, but if you have those skills, then technology makes you more productive, and that's what we need. Incomes can only rise if productivity is increasing. We're sort of working as many hours as we can work now, so it really is down to how much output can you have in an hour, and that's productivity. So I would recommend that. I'm not getting any royalties for that, but by the way, Claudia Golden won the Nobel Prize for her work about 2 years ago, so I'm not the only one who thinks it was good work.
Chair Powell, let's move on to tariffs. This is an issue that confronts the business people here with us today. You addressed it very briefly in your opening remarks. You indicated that you believe that the costs of the tariff movement is in fact more transitory than embedded in supply chain. So I think we would appreciate hearing more about how the Fed thinks about evolving tariff policy.
So we're now collecting a good bit of revenue. The federal government collecting a good chunk of revenue, at a $300 or $400 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, or someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example. I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then are they going to eventually be able to pass that stuff through, and then that might drive inflation up a little higher? So we've been watching this since the beginning. Half our mandate is inflation. And I would say that the pass-through to consumers has been later and less than we expected. How much of that will continue, I don't know. But the responsible thing from our standpoint was to watch and wait, because it's our job to make sure we don't make a mistake on inflation.
Well, that was my question. Do you imagine that is going to change, where the cost of tariffs will be more deeply embedded and passed on to the consumer? What do you foresee?
So our forecast, and I think almost all the forecasts are for there to be a one-time pass-through, which will go through the end of this year, well into next year, and that by the end of next year, the one-time increase from the tariffs will be done, and you'll be back to the non-tariff related inflation, which should be much closer to our 2% goal. That's almost everyone's base case. It's actually our job to make sure that that's the outcome, though. So we can't be in a situation where we're just going to assume that. We can't leave that part of the goal unguarded. And so that's why we've been careful about cutting. We didn't want to cut too early. I mentioned in my remarks, if we cut too early, we may find out in a year that inflation actually wasn't under control and it's back up to 3.5% or 4%. No one thinks this is the base case, but that's the risk of cutting too early or too much. Of course, the risk of cutting too late, as I mentioned, is that we unnecessarily, the labor market weakens unnecessarily. There's no risk-free path, and it's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise, and we really, again, haven't been in that situation for many, many years. It does happen. But it's happened now, and we'll manage our way through it. But we sort of have to look at both of them as equal. We can't just say we're going to do this one and not that one, unless this one is clearly a greater risk. And now they're coming into closer balance, I would say. We do see meaningful weakness in the labor market now, very low job creation. The unemployment rate's still low, though, and the quits rate is low, and a lot of things suggest that the labor market has reached a kind of unusual stability of much lower demand and much lower supply for workers. It's a really unusual kind of a balance, if you want to call it that, but nonetheless, we think it's downside risk.
Well, if you could elaborate, what are some of the factors that are leading to depressed demand for labor?
So depressed demand for labor, based on surveys and talking to people who are doing hiring, a big chunk of it is that they're just unsure about what to do. Businesses, and I'd love to talk to people after this. Businesses don't want to do a lot of hiring. They may be postponing major capex, major initiatives, major acquisitions, and maybe they'll replace workers who retire, but they're not looking to grow. This isn't every company and every part of every company in the world. It's just an effect kind of at the margin. That's got to be part of it. I think that's the demand side. The supply side, of course, has a lot to do with immigration policy. So immigration was at a very high level for 2 or 3 years before this year, and now immigration has really gone close to zero, and immigration is not really contributing to the labor force growth now, whereas it's been most of what the labor force growth was, and now so at the same time you've got declining demand and also declining supply of workers, of new workers.
One of your passions is demystifying the Fed. You enjoy speaking about it, and those that are Fed watchers are wondering, will there in fact be 2 additional rate cuts before the end of the year? Of course, we're uncertain about that, if I understood your comments correctly. What does it mean to demystify the Fed, and what can each of us in this room do to be better Fed watchers for the benefit of our own businesses, if you will?
So not so many years ago, maybe 40 years ago, and for a long time before that, the main theory of central banking was to be mysterious and obscure. In fact, Montague Norman, who's a very famous former head of the Bank of England, but ending in the middle of World War II, famously said, never apologize, never explain. And he thought that monetary policy worked back, and everyone thought, it works best when no one understands. It's kind of mysterious. So starting maybe 40 years ago, a bunch of economists, including Alan Blinder and a number of others, said, you know what, that's wrong, because if markets and the public understand the way you'll react to incoming data, then they'll kind of do your job for you. And so they argued for greater transparency. And people said, you know what, that makes sense. So central banks started being transparent. The Fed didn't even issue a post-Federal Open Market Committee announcement until 1994, and then did so as an experiment just to see what would happen. Now, so if you fast forward through the 30 years since then, now we have a post-meeting statement, we have minutes, we have press conferences, every FOMC participant is on Squawk Box, we have a press release. So, and maybe some people say it's too much, it's excessive, but so that's the way it's evolved. So we try really hard to communicate with the interested public in a way that is useful and comprehensible and jargon-free. That's what we focus on, and that's all we're trying to do. So we don't use their, every profession has their jargon, and you kind of need it for internal conversations, but we try not to do that. So that's all we're trying to do. A couple of thoughts about what I wouldn't say, I can't make anyone a better Fed watcher, I don't think, but things I would want to tell people about the Fed. One is just this, that we're making decisions, our decisions are made under elevated levels of uncertainty, even in normal times. The economy is fundamentally, no one has been able to predict the economy more than for the next few months. It's an unpredictable, it's this enormous entity, and it's just not that predictable. So we have to we take very much a risk management approach, and one of the risks we're managing is that we don't exactly understand what the current state of the economy is and where it's going to go. So we try to have policy that can cover the range of plausible outcomes, not just one outcome. So that's one thing. So we're never saying that we know the economy is going to do this or we know it's going to do that, because honestly, it just, famous statement is, financial forecasters are a humble lot with much to be humble about. So that's one thing I would say. Another is that you should, I just have to say this, whenever we make decisions, we're never, ever thinking about political things. And so we're based in Washington, D.C., and many people, in Congress, and they're often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, most of the people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't. Our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do. So those are two things I would offer about the Fed.
We have run out of time. We have come to the end of our program, and I'm wondering if there's anything additional that you'd like to share with the members here today, and again to help us be more prepared as we begin to look to 2026 and strategic plans for business and things on the horizon that would help to, of course, create more jobs and more prosperity.
So I'll say one more thing that struck me just now about the Fed, and that is, remember, we have a really important job: maximum employment, price stability. We regulate and supervise the banks. We operate parts of the payment system. But those things are really about cyclical demand management and financial stability. The policies that really matter for the U.S. economy in the long run, things like investment, particularly investment in people, that's not something we can do. I think we get a disproportionate amount of attention compared to the things that really matter for the country, which are the things that Congress can do and the private sector can do, which are the things that will really matter for future generations, are not interest rate policy and the things that we do as important as we are. And beyond that, I'll just say this has been great, as always. I've enjoyed talking to so many people here today, and I love to get out and talk to people who are working in the real world, in the economy. There's nothing better than that. Most of my career was in the financial sector, and I constantly was out talking to people rather than sitting in my office looking at aggregate data on the economy. So this is a much more comfortable place to be.
You are headed back to D.C. later this afternoon.
Yes.
What does the rest of your day look like?
Get home. I won't get home until after dinner, so looks like me working on the plane on the way back. So anyway, thank you so much. It's been great.
Thank you.
Thank you.